Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me on the phone, we have Pierre Debbas, who's a managing partner at Romer Debbas. We're going to take a look at the coronavirus shutdown and how that's having negative and positive implications for the real estate market. Pierre, thanks so much for joining us in what has truly been unprecedented times in the market.
Definitely, Joe. Well, thank you for having me, and hope everybody out there is being safe.
All right. Well, thank you. Let's take a look at some short-term negative trends and the immediate impact that you're seeing on the real estate market.
Yeah, the short-term trends are obviously having a negative impact on the market. And the unfortunate thing is, prior to the coronavirus, the market had been doing quite well. To start the year, the first quarter, generally speaking, is not the strongest quarter in the real estate market. And in January, we had great stats where we had the second highest total of contracts signed for home purchases in the country in the last 2 years for any month. So it was a great sign to start 2020, especially with interest rates even declining further and a current refi boom taking place. And it's unfortunate that the coronavirus hit and is now going to derail all that positive information and trends going into the year. And honestly, what we're seeing right now is the whole market has come to a halt. Open houses are not going to be able to take place. Brokers are trying to get creative and create virtual tours, or maybe scheduling one-on-one appointments to view properties. I think the latter will likely not be permitted if this continues to get worse. And in reality, nobody's going to commit to buying an illiquid asset in such an uncertain economic time. So the immediate impact is essentially the market's come to a halt. Now, will this play out? How will this play out the balance of the year? I think that's the next question. If you'd like, I'm more than happy to jump right into that, because I have some optimistic thoughts on that topic.
Before we get into the positive trends that we're seeing, though, you and I have spoken about this before, where retail continues to be an ongoing issue, and forced closure of stores, that's actually going to increase to an uptick in the foreclosure on commercial property owners. I mean, we saw that happening in New York City even before we knew what coronavirus was.
Yeah, I mean, if I recall correctly, you and I talked about this on Cyber Monday last year, and we were not optimistic on the retail situation. And retail, this is going to, I mean, no one foresaw this coming. Retail is going to be the asset class in the real estate world that's hit the hardest by this. Retail is already struggling with everything going on with online shopping, Amazon, and so on and so forth. And now, with stores being forced to shut down, potential curfews, people not being able to leave their homes, or people being afraid to leave their homes, I don't know how retail can, overcome this anytime soon. This is definitely going to result in, talking to tenants, the first thought every tenant's head is, how can I renegotiate my lease or work out a payment plan, because there's no way I'm making my lease payments if I'm forced to shut down for a prolonged period of time.
All right, let's wrap this up with some positive trends that you're seeing in the longer term.
Well, the positive trends are rates went down, and banks are seeing higher loan applications for refinances than they've seen in years. I believe the amount of loan application refis doubled last week with the reduction in rates. And we talked about this a number of times in the fourth quarter of 2019. There was 3 cuts in the Fed rate last year, and we went into this year thinking rates would be the same and there'd be no cut or no increase. And that was a factor for whether there'd be a sense of urgency entering the market or not. Now, with rates even reducing further, I think once we have some level of stability, or, have a better idea of what this coronavirus will entail, I think you're going to see activity pick right back up. I think that you're in year 4 of a correction in pricing. And prior to the coronavirus, the economy was doing exceptionally well. Rates have gone down, prices have come down, across the board. And I think you're going to have a pent-up demand in consumers. And I think quarter 3 and quarter 4 this year could be exceptionally good years for the real estate market, or good quarters, I should say, so long as this virus doesn't get, significantly worse than it is across the world right now.
What about rent-to-own options?
Well, rent to own's always been a concept that we've heard, and it really depends on the market that we're in and the specific asset class. So, ironically enough, where I'm seeing in the high-end luxury market in New York City is that developers are offering rent-to-own options to address the lack of demand in the high-end market. Obviously, we all know that that the high-end market has a glut in supply, and there has not been much of an interest in that product for the last year or two. Now, the rent to own provides prospective buyers the ability to rent the apartment, live there, potentially apply a portion of the rent to the purchase price should they exercise their option to buy. So in a market like this, when the stock market's down, north of 20%, and a lot of people lost a significant amount of liquidity and net worth, the rent-to-own option gives you the ability to recoup some of that lost liquidity and also have the ability to benefit from part of your rent going towards that purchase price, which, should spark some demand in the high-end market.
All right, Pierre, great insight as always. Thanks so much for joining us.
Thank you, Jill. Appreciate it.
All right, and thank you for joining me on Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.